Hi friends, this is a very important problem. Most possibly of getting 12 marks, 15 marks, 14 marks, whatever it might be, depending upon the universities they set their marks. Okay, you can observe this is the valuation of securities. The concept here is variable growth in dividends. The steps for valuation of shares. In case of variable growth in dividends, the following steps may be taken in order to value equity shares. Compute the amount of dividends receivable for different year during initial period of supernormal growth. Find out the present value of dividends computed above by applying the discounted factors from the present value tables. Apply the normal growth rate of dividend received for the last year of supernormal growth period to compute the expected dividend for the first year of normal growth period. Compute the market price of the equity share by applying the formula given for constant growth in dividend. Find out the present value of market price of the share by applying the PV factor to the market price computed under point 4 above. Add the present value of dividends computed under point 2 and the present value of shares computed under point 5 above. The resultant figure is the desired present value of shares. The working steps can be understood with the. Now you can observe the question. A company is expected to pay a dividend of rupees 4 per share after a year. Its dividends are then expected to grow at 15% for next 5 years and then at the rate of 8% indefinitely. Find out the present value of its share if the capitalization rate is 12%. Here you have to observe the point rupees 4 per share. Okay, here is the steps how to calculate a solution. Step 1, calculation of present value of dividends. See here they are given a company is expected to pay dividend rupees 4 after a year, means after a year it would be the growth rate is 15%. So you can observe in this table first year it is the dividend rate 4, so I have taken it as itly. Here is the PV factor, that is capitalization rate. We will consider the PV factor at 12%. How to calculate this table I will explain you. uh, Here you can observe if dividend is 4, it is 4 after second year. Next 5 consecutive years it's 15%. So 4 into 1.15, 1.15 how you get 1 plus 15%, means after 1 year, right? So after 1 year 1 plus 15%, if you convert it with mathematics, 15% is 0.15, 1 plus 0.15 is equal to 1.15. Okay, here upon the dividend you apply, that is 4 into 1.15, 4.16, 4.16 into 1.15, 5.29, 5.29 into 1.15, 6.08, so on. So you take it consecutively. Your PV factor, a present value, if you add this total present value, you will get total present value. How to calculate this discount factor or PV factor? Here you can observe there is a formula. First year PV factor 1 divided by 1 plus r to the power of n. So 1 divided by 1 plus 0.12, here 1.1 divided by 1.12, 0.893. If you calculate for first year, next consecutive years you can calculate directly by calculator. I will show you guys how to that. See, if you apply this formula, the final concluded is 1 divided by 1.12. First you have to reset your calculator. So 1 divided by 1.12, if you set, see 0.892, 0.893, means here you have to round off to one segment, 3 decimal points. If you round off, you will get 0.893. You will get for consecutive years, you will get PV factor here. See, you can observe here 6.635, 0.635, 0.636, means round off. Okay, if you do consecutively you will get here you have to round off to 1, that is 0.507 you will get if you round, because here there is 6, so if you round off 0.507 you will get. So here you can observe 0.507. After that, guys, here you have total present value. So next, take your steps. Step 2, after the expiry of 6th year, from 7th year onwards, the growth in dividends is 8% indefinitely. Hence, the dividend for the 7th year is likely to be 8.05 into 1.08 is equal to 8.694. See, 8.05, it is somewhat this at the end of 6th year into 1.08 if you do, because after this, see here you can observe, for 5 consecutive years it's 15%, after that it is 8%, means here after 5 consecutive years 15%, after the 6th year, the 7th year, 8th year, 9th year, 10th year, you will get 8%. So 1 plus 8% is equal to 1.08. 8.05 into 1.08 you will get 8.694. Apply the formula for valuation of shares under constant growth in the dividend to find the present value at the end of 6th year. If you calculate this formula is, in simple words I have written, dividend divided by capitalization rate minus growth rate. This is symbolic representation. For 6th year you are finding, that is valuation of equity share at the end of 6th year, that represents P6. Okay, if you substitute the values you will get P6, that is end of 6th year valuation of equity share is equal to 217.35. Here 0.08, because at here you can observe after 6th year it is 8% indefinitely. Okay, now the present value of share calculate under point 2 by applying PV factor of the year 6, that is 0.507. Present value of share, if you calculate you will get 1110.02. Now add to the present value calculated under 3 above the present value of dividends receivable for 6 years calculated under first above, means this one. Okay, under 3 means here you can observe this is under 3. So if you add things, that is 110.20 under 3, and in the first column above, see here you can observe, guys, point 2 and point 1. This is point 1, right? Here point 1 is 22.93. This one you have to add with point 3, that is 1110. If you add this you will get the final value of equity share, that is 113.13. Thank you.